Mid-cycle volatility just quietly erased months of gains for millions of investors, and most of them had no idea it was coming. We're not talking about a crash, a crisis, or a headline-grabbing collapse. We're talking about the slow, grinding, maddening churn that happens right in the middle of a bull market, when everything feels fine until it suddenly doesn't. The catalyst here isn't some black swan flying in from nowhere. It's actually the Federal Reserve doing exactly what it said it would do, and markets throwing a tantrum anyway. Think of it like a road trip, where the driver announces they're slowing down, and half the passengers immediately start panicking and asking to get out of the car. Just a year ago, the headlines were practically writing themselves. Soft landing achieved, rate cuts incoming, the everything rally is back. Now, those same publications are whispering about stagflation, sticky inflation, and a Fed that might be out of ammunition, which is a pretty dramatic glow up in the wrong direction. The psychological toll of mid-cycle uncertainty is real, and even seasoned investors start second-guessing positions they held with total conviction 6 months ago. As the old Howard Marks saying goes, the most dangerous words in investing are, "This time it's different." But the second most dangerous might be, "I knew this was coming," said by someone who did absolutely nothing about it. History is littered with these mid-cycle wobbles that felt catastrophic in the moment, but look like speed bumps in hindsight. 1998, 2011, 2015, 2018. Each one unique in its trigger, but eerily similar in its emotional signature. The stats back this up. Since 1950, the S&P 500 has experienced an average intra-year decline of about 14%, even in years that ended positively, which means volatility isn't the exception, it's practically the job description. Mid-cycle volatility is essentially the market's way of repricing risk between the euphoria of early expansion and the exhaustion of late-cycle excess. And if you understand that, you stop treating every red week like the apocalypse. Community voices across every investing forum right now are split between buy the dip aggressively and cash is king. And honestly, both camps have historical precedent on their side depending on your time horizon. One of the biggest misconceptions floating around is that protecting your portfolio means moving everything to cash or bonds, which is actually just trading one risk, market risk, for another, which is inflation risk, quietly eating your purchasing power alive. Diversification isn't a buzzword. It's the closest thing to a free lunch that finance actually offers. And mid-cycle moments are precisely when you find out whether your allocation was real or just theoretical. The practical playbook here isn't glamorous, but it works. Rebalance back to your target allocation, trim positions that have grown oversized relative to your original thesis, and add exposure to historically defensive sectors like utilities, consumer staples, and healthcare without completely abandoning growth. Dollar cost averaging during volatile periods has consistently outperformed lump sum panic buying or panic selling across nearly every studied time window, which means the boring, robotic, unemotional approach wins again. Position sizing is where most individual investors quietly sabotage themselves. They're right about the thesis, but wrong about the size. And a single over-leveraged position can turn a manageable drawdown into a life-altering event. The goal isn't to maximize the upside on any single idea. It's to stay in the game long enough for compounding to work its actual magic, which requires surviving the bad stretches without blowing up. Process beats conviction every single time in the long run, and the investors who thrive through mid-cycle turbulence are almost never the ones who called it correctly. They're the ones who had a written plan and followed it when their emotions were screaming at them to do the opposite. Patience isn't passive. It's an active, disciplined choice you make every single day when the market is testing your resolve. There's something almost poetic about the fact that the most boring investors, the ones with boring allocations, boring rebalancing schedules, and boring risk management consistently outperform the ones making bold, exciting, high conviction calls that make for great content but terrible returns. The irony is that financial media profits from your anxiety while your brokerage account benefits from your indifference. At the end of the day, the philosophical truth of investing is that uncertainty is not a bug in the system, it is the system. And the price you pay for long-term returns is the discomfort of not knowing what happens next. Discipline, sizing, and consistency aren't just tactical tools. They're the entire game, dressed up in different costumes depending on the cycle. Being comfortable with any outcome isn't resignation. It's the highest form of preparation. Because if you've sized correctly, diversified honestly, and rebalanced mechanically, you don't need the market to cooperate to be okay. Rational preparation is the only edge that doesn't get arbitraged away, and it's available to every single investor regardless of account size or market access. Whether markets grind higher, chop sideways for 2 years, or sell off another 15%, none of those outcomes change the fundamental strategy. You stay diversified, you stay disciplined, you stay sized appropriately, and you let time do the heavy lifting that no indicator or analyst can replicate. The mid-cycle moment isn't the enemy, your reaction to it is. And if you're ready to put these principles to work beyond just your stock portfolio, whether that's real estate investing, home contracting projects, or connecting with the right lenders, check out our links in the description below, and let's build something together.